Ladies and gentlemen, at exactly 9:47 a.m. Eastern Standard Time on a Tuesday that will be remembered as one of the most explosive moments in modern financial history, a document marked confidential landed on the desks of senior partners at Goldman Sachs, Morgan Stanley, and JP Morgan Chase. Within 11 minutes, the S&P 500 had plunged 127 points. Within 23 minutes, the VIX volatility index had spiked above 28. Within 41 minutes, emergency trading desks across Manhattan were lighting up with panic calls from institutional clients demanding immediate portfolio hedges. The document contained 3 words that sent a seismic shockwave through every trading floor from New York to London to Hong Kong. Department of Justice. Criminal probe. Jerome Powell. What you're about to discover isn't just another financial news story that will fade into the background noise of market commentary. This is a moment that threatens to unravel the very fabric of trust that holds the global financial system together. A moment when the most powerful central banker in the world found himself in the crosshairs of federal prosecutors. And a moment when trillion-dollar questions about monetary policy, institutional credibility, and the future of American economic power suddenly became existential threats rather than academic debates. The implications of what's unfolding right now are so profound that major hedge funds have already begun executing contingency plans that haven't been dusted off since the 2008 financial crisis, and the whispers in private wealth management circles suggest that some of the smartest money in the world believes we're standing at a historical inflection point that could reshape global finance for the next generation. To understand why this DOJ criminal probe into Federal Reserve Chairman Jerome Powell has triggered such an unprecedented reaction across global markets, you need to understand something that very few people outside the inner sanctums of central banking truly grasp. The Federal Reserve doesn't just set interest rates and manage monetary policy. It is the gravitational center of a $70 trillion ecosystem of bonds, derivatives, currencies, and credit instruments that touch every pension fund, every retirement account, every mortgage, every business loan, and every government borrowing program on the planet. When confidence in the Fed wavers even slightly, the ripple effects don't just spread, they amplify exponentially because modern finance is built on a foundation of trust, predictability, and the ironclad belief that central bankers operate above political pressure, personal interest, and criminal liability. The criminal probe reportedly centers on allegations that emerge from an internal whistleblower within the Federal Reserve System itself, someone with access to communications and decision-making processes at the highest levels of monetary policy formulation. According to sources familiar with the investigation who spoke on condition of anonymity due to the sensitive nature of the ongoing probe, the DOJ is examining whether Powell or senior Fed officials engaged in potentially illegal coordination with major financial institutions regarding the timing of interest rate decisions, whether certain privileged market-moving information was shared with select Wall Street firms ahead of public announcements, and most explosively, whether personal trading activities by Fed officials during the pandemic era involved securities or positions that benefited directly from non-public policy deliberations. Now here's where the story transforms from a regulatory matter into a full-blown crisis of institutional legitimacy that threatens the operational foundation of global monetary policy. Within hours of the news breaking through Bloomberg terminals and Reuters alerts, Treasury yields began moving in ways that seasoned bond traders described as incoherent and divorced from fundamental analysis. The 10-year Treasury yield, which had been trading in a relatively stable range around 4.2%, suddenly spiked 43 basis points in a single session as institutional investors began pricing in a scenario that most had considered unthinkable just 24 hours earlier. What they were pricing in wasn't just the possibility of Fed leadership disruption, but the systemic risk that comes when the referee of the financial system becomes a defendant in a criminal investigation. The mathematics of market psychology are brutal and unforgiving in moments like these. Every basis point move in Treasury yields represents billions of dollars in portfolio revaluation across global fixed income markets. A 43 basis point spike translates to hundreds of billions in mark-to-market losses for bondholders, which triggers margin calls, which forces asset liquidation, which creates downward pressure on equity prices, which spikes volatility metrics, which triggers algorithmic trading protocols that amplify the selling pressure, which feeds back into bond markets as investors flee to even safer havens. This is the cascade effect that keeps risk managers awake at night, and it was unfolding in real time as traders watched their screens with a mixture of disbelief and dawning horror. But the bond market disruption was just the opening act of a much larger drama playing out across multiple asset classes simultaneously. Currency markets, those vast oceans of liquidity where $5.3 trillion changes hands every single day, began exhibiting the kind of violent swings typically reserved for geopolitical crises or major central bank policy surprises. The US dollar index, which measures the greenback's strength against a basket of major currencies, initially surged on safe haven demand as algorithmic traders and systematic funds piled into dollar-denominated assets reflexively. But then, something unusual happened that revealed just how deep the uncertainty had penetrated into market psychology. The dollar began to weaken despite the chaos, falling nearly 2% against the Swiss franc and 1.7% against the Japanese yen within the first trading session after the probe news broke. Currency strategists who've spent decades analyzing foreign exchange dynamics were calling this price action schizophrenic because it violated the normal safe haven patterns that govern dollar behavior during market stress. What was happening was a tug of war between two powerful forces. On one side, the reflexive flight to dollar liquidity that happens whenever global markets panic. On the other side, a more insidious concern that if the Federal Reserve's credibility is compromised, if Jerome Powell's position becomes untenable, if the institution itself becomes politicized or delegitimized, then the very foundation of dollar dominance in the global financial system comes into question. International central banks, holding trillions in Treasury securities as reserves, were suddenly facing questions they never wanted to contemplate. Sovereign wealth funds in Abu Dhabi and Singapore were convening emergency meetings. Chinese monetary officials were reportedly analyzing scenarios for accelerating de-dollarization initiatives that had been theoretical exercises just days before. Meanwhile, in the physical and financial gold markets, something extraordinary was taking place that veteran precious metals traders were calling the most aggressive safe haven bid they'd witnessed since the European debt crisis. Gold futures spiked $217 per ounce in just under 48 hours, blowing through technical resistance levels that had held for months and triggering a cascade of programmatic buying from commodity trading advisors whose algorithms detected a major regime change in progress. But the real story wasn't happening in the futures pits of Chicago and New York. It was happening in the opaque world of physical gold demand, where central banks, ultra-high net worth families, and institutional investors with access to wholesale bullion markets were quietly placing orders that threatened to overwhelm available supply. Dealers in London and Zurich were reporting that premiums for physical gold bars had spiked to levels not seen outside of acute crisis periods, with some transactions clearing at $15 to $20 over spot price as buyers scramble to convert paper wealth into tangible assets that exist outside the banking system entirely. This wasn't retail investors buying gold coins from late-night television advertisements. This was serious institutional money, the kind that moves in $100 million increments, making a calculated decision that the risk of Federal Reserve delegitimization was severe enough to warrant emergency portfolio restructuring regardless of the transaction costs involved. The equity markets were experiencing their own existential crisis, but in a more complex and layered way that revealed just how dependent modern stock valuations have become on the perception of Fed competence and predictability. The S&P 500's initial plunge was severe, but somewhat expected given the magnitude of the news. What happened over the following trading sessions was more revealing and more concerning. Certain sectors and certain types of stocks began exhibiting bifurcated performance that told a story about what institutional investors were really worried about underneath the headline volatility. Financial stocks, particularly the major money center banks and broker-dealers that interact most directly with Federal Reserve operations, were getting absolutely demolished. Bank of America dropped 7.3%. Wells Fargo fell 6.8%. Morgan Stanley shed 8.2%. These weren't just sympathy moves reflecting broad market weakness. These were specific, targeted selling decisions, based on a calculation that banks with the deepest Fed relationships might face enhanced regulatory scrutiny, operational disruption, or reputational damage from association with an institution under criminal investigation. At the same time, defensive sectors that typically outperform during periods of policy uncertainty and economic fear were behaving strangely. Utilities, consumer staples, and healthcare stocks, the traditional safe havens within equity markets, were actually underperforming the broader market in some sessions. This counterintuitive price action was revealing something profound about investor psychology. The usual playbook for navigating Fed uncertainty wasn't working because this wasn't usual. Fed uncertainty about interest rate decisions or inflation forecasts. This was fundamental uncertainty about whether the institution itself could continue functioning with its credibility intact, whether monetary policy could remain insulated from political interference if criminal proceedings ensnared its leadership, and whether the post-2008 regime of central bank dominance over financial markets might be entering a terminal phase. Portfolio managers running multi-billion-dollar funds were facing an almost impossible challenge in this environment. Traditional risk models that had been calibrated over decades of relatively stable central banking operations were essentially useless for quantifying the tail risks associated with Fed delegitimization. How do you model the probability distribution of outcomes when one of the fat tail scenarios involves the chairman of the Federal Reserve potentially facing criminal charges? How do you stress test a portfolio for a situation where the institution responsible for providing emergency liquidity to the financial system during crises might itself become the source of the crisis? These aren't questions with satisfying answers, which is why so many institutional investors were defaulting to the only strategy that makes sense when your risk models break down completely: reduce gross exposure, raise cash levels, and wait for clarity that might not come for months. The options market was painting an even more alarming picture of just how much fear had infiltrated the institutional investment community. The CBOE Volatility Index, better known as the VIX, or the fear gauge, had spiked above 28. But that headline number actually understated the true level of concern coursing through derivatives markets. When you looked at the term structure of VIX futures, the shape of the curve was screaming that traders expected this uncertainty to persist and potentially intensify over the coming months. The slope of the VIX futures curve had inverted into a pronounced backwardation pattern, meaning that near-term volatility was trading at a significant premium to longer-dated volatility, a configuration that typically only emerges when market participants believe a specific identifiable crisis event is imminent and likely to cause severe disruption before any resolution or stabilization occurs. But the truly sophisticated money was making even more specific bets that revealed what Wall Street insiders were really worried about beneath the surface chaos. Put option volumes on financial sector ETFs had exploded to levels that made the 2008 financial crisis look like a minor market correction by comparison. These weren't small retail traders buying lottery ticket puts hoping for a windfall. These were large institutional block trades, the kind that moved through dark pools and specialized derivatives desks, representing genuine hedging activity by firms with massive exposure to financial sector risk. What they were hedging against wasn't just stock price declines. They were hedging against the possibility that the entire post-crisis regulatory and monetary policy framework that had governed financial markets since 2008 might be entering a period of fundamental transformation or even breakdown. Credit markets were sending similarly ominous signals that the smart money was preparing for scenarios that most headline financial commentary wasn't even considering. Credit default swap, spreads on U.S. sovereign debt, the cost of insuring against a U.S. government default, had widened to levels not seen since the 2011 debt ceiling crisis and the 2013 government shutdown. Now, let's be clear, nobody seriously believes the United States is going to default on its debt obligations in any conventional sense. But CDS spreads don't just reflect default probability in a literal sense. They reflect broader concerns about policy dysfunction, institutional credibility, and systemic risk. The fact that sophisticated credit traders were willing to pay substantially higher premiums to hedge their Treasury holdings was a direct statement about diminished confidence in the stability and predictability of U.S. monetary and fiscal institutions. Corporate credit markets were experiencing their own crisis of confidence as borrowing costs spiked and credit availability tightened in ways that threatened to choke off the flow of capital to businesses across the economy. Investment-grade corporate bond spreads had widened by 90 basis points over comparable Treasury yields, a move that translates directly into higher borrowing costs for every company trying to issue debt to fund operations, expansion, or refinancing. High yield spreads, the premium that riskier borrowers must pay above risk-free rates, had exploded by over 200 basis points as junk bond investors fled to safety and demanded substantially higher compensation for credit risk, in an environment where the Fed's willingness and ability to provide emergency liquidity support had suddenly become questionable. This credit market disruption wasn't just an abstract financial market phenomenon. It had immediate real economy consequences that were already beginning to ripple through corporate America. Companies that had been planning bond offerings to fund expansion projects were pulling deals from the market or postponing issuance indefinitely. Firms with upcoming debt maturities were discovering that refinancing costs had spiked so dramatically that profitability projections and business models built on assumptions of continued low interest rates were suddenly untenable. The credit-dependent sectors of the economy, particularly commercial real estate, leveraged finance, and private equity, were facing a potential liquidity crunch that threatened to cascade into defaults, asset fire sales, and broader economic contraction if the Fed uncertainty persisted for more than a few weeks. International markets were experiencing their own versions of this chaos, but with an additional layer of complexity stemming from questions about dollar stability and Fed credibility's impact on global financial plumbing. European markets had initially opened sharply lower in sympathy with U.S. futures, but then something interesting happened that revealed the fault lines in the transatlantic financial relationship. German bond yields, typically correlated closely with Treasury yields due to similar safe haven characteristics, began diverging from U.S. yields in a way that suggested European investors were actually viewing European sovereign debt as potentially safer than U.S. Treasuries for the first time in modern memory. The spread between 10-year Treasury yields and 10-year bond yields had narrowed by 67 basis points in just 3 trading sessions, an enormous move that reflected a fundamental reassessment of relative institutional credibility between the Federal Reserve and the European Central Bank. Asian markets were experiencing even more severe dislocations as the dual time zone delay meant that Asian investors were getting the news during their trading hours and having to react in real time without the benefit of seeing how US and European markets would stabilize or continue falling. The Nikkei had dropped 3.8%. The Hang Seng had plunged 4.2%. The Shanghai Composite, typically insulated from U.S. market moves by capital controls and government intervention, had still managed to fall 2.1% as Chinese investors recognized that Fed instability threatened the dollar-based trade and financial flows that Chinese exporters and importers depended upon. But the most revealing price action was happening in emerging market currencies and bonds, where the carry trade and dollar funding structures that had been built up over years of stable Fed policy were beginning to unwind in violent fashion. The Turkish lira had cratered another 6% against the dollar despite intervention efforts by the Turkish central bank. The Brazilian real had fallen 4.3%. The South African rand had dropped 5.7%. These weren't just random currency fluctuations reflecting local economic conditions. These were liquidation flows as international investors unwound emerging market positions funded with dollar borrowing, positions that only made sense in a world where Fed policy was predictable, dollar funding was reliable, and the risk of major monetary policy disruption was essentially zero. That world had evaporated in the span of a morning Bloomberg headline, and the resulting capital flight from emerging markets threatened to trigger the kind of contagion that had devastated developing economies during the 1997 Asian financial crisis and the 2013 taper tantrum. Now here's where this story gets even more complex and more concerning for anyone trying to understand the true magnitude of what's unfolding. The criminal probe into Jerome Powell isn't happening in a vacuum. It's happening at a moment when the Federal Reserve was already facing enormous pressure from multiple directions simultaneously, pressure that was already testing the limits of the institution's credibility and operational capacity even before criminal allegations entered the picture. The Fed had spent the previous 2 years navigating the most aggressive interest rate hiking cycle in 4 decades, trying to combat inflation that had reached levels not seen since the early 1980s, while simultaneously trying to avoid triggering a recession or financial crisis. It was a high-wire act that required maximum credibility, maximum institutional trust, and maximum confidence that Fed officials were making policy decisions based purely on economic data and mandated objectives rather than political pressure or personal interest. The timing of this probe couldn't be worse from a monetary policy perspective because the Fed was at a critical juncture in its rate policy cycle where market expectations, forward guidance, and institutional credibility were absolutely essential tools for managing financial conditions. The Fed had been trying to signal that interest rates might remain higher for longer than markets had been pricing in, trying to push back against premature rate cut expectations that could loosen financial conditions prematurely and reignite inflation. But that message requires absolute credibility to land effectively. It requires markets to believe that Fed officials are making decisions based on their interpretation of economic data and their commitment to their dual mandate of maximum employment and price stability rather than any other consideration. The moment a criminal probe introduces the possibility that Fed officials might have been influenced by personal financial interests, by inappropriate relationships with Wall Street firms, or by any motivation other than pure policy judgment, the entire forward guidance framework collapses. Markets can no longer trust what Fed officials say in speeches and press conferences. The dot plot projections of future rate paths become meaningless if there's any question about whether those dots reflect genuine policy intentions or something else. The meeting minutes and policy statements that markets parse for signals become uninterpretable noise if the underlying decision-making process is potentially compromised. This credibility collapse has immediate and devastating consequences for the Fed's ability to control financial conditions, which is really the mechanism through which monetary policy affects the real economy. The Fed doesn't directly control long-term interest rates, equity valuations, credit spreads, or currency exchange rates. It controls the overnight federal funds rate and uses that control, combined with forward guidance and credibility, to influence longer-dated rates and broader financial conditions. But when credibility evaporates, when markets stop believing Fed communications or start questioning whether policy decisions are being made for the stated reasons, the Fed loses its primary tool for affecting financial conditions beyond the very short end of the yield curve. What we're witnessing in real time is essentially a stress test of this credibility mechanism, a test that the Fed appears to be failing quite dramatically if market price action is any indication. Despite the Fed's official position that the criminal probe won't affect its policy deliberations or operational independence, despite reassurances from Treasury officials and other government authorities that the monetary policy framework remains intact, markets are voting with trillions of dollars that something fundamental has broken. The term premium in Treasury yields, the extra compensation investors demand for holding longer-dated bonds given uncertainty about future interest rates and economic conditions, has spiked to levels that suggest markets believe there's genuine possibility of policy chaos or institutional breakdown ahead. Behind closed doors, in the private conference rooms and secure communication channels where the real power players of global finance make their most important decisions, conversations are happening that would shock most people, if they could listen in. Senior partners at the largest private equity firms are discussing whether to pause all new investments until the Fed situation clarifies. Chief investment officers at major pension funds are evaluating whether to dramatically increase allocations to alternative assets that exist outside the traditional banking and financial system. Sovereign wealth fund managers are having quiet conversations with bullion dealers about whether it's possible to take physical delivery of multi-billion-dollar gold positions without moving markets. The corporate treasurers at America's largest companies are drawing down credit lines and hoarding cash, despite having no immediate need for the liquidity, operating from a playbook that says, when you see smoke in the financial system, you get liquid first and ask questions later. The risk management committees at major banks are running scenarios and stress tests for situations that weren't even considered possible just days earlier, trying to quantify exposure to a Fed credibility crisis, and discovering that the honest answer is that exposure is essentially unlimited because the entire financial system's stability depends on Fed credibility at its foundation. What makes this situation particularly dangerous isn't just the immediate market volatility and financial disruption, severe as that is. The deeper threat is the possibility that this probe triggers a political feeding frenzy that ends up compromising the Fed's operational independence in ways that persist long after the current crisis fades. There are already senators and representatives from both political parties calling for emergency hearings, demanding documents and testimony, introducing legislation to reform Fed governance structures. Some of this scrutiny might be justified and necessary. But there's also a very real risk that the probe becomes a vehicle for political actors to exert pressure on monetary policy decisions, to second-guess interest rate judgments through the lens of criminal investigation rather than economic analysis, to effectively politicize the Fed in ways that would be nearly impossible to reverse once the Pandora's box is opened. Historical parallels are instructive here, though imperfect, because we've never seen anything quite like this before. The closest analog might be the period in the 1970s, when the Federal Reserve's credibility hit rock bottom amid accusations that monetary policy was being subordinated to political pressure to keep unemployment low and interest rates artificially suppressed despite rising inflation. The consequence of that credibility collapse was the great inflation of the 1970s that required Paul Volcker's brutal interest rate shock therapy in the early 1980s to finally break. The lesson from that era is that once Fed credibility is lost, once markets stop believing that monetary policy is being conducted independently and competently, the cost of rebuilding that credibility is measured in recession, unemployment, and years of economic pain. The other historical parallel that sophisticated analysts are quietly discussing is the transformation of central banking after World War I, when the gold standard's demise and political interference in monetary policy contributed to the hyperinflations in Germany and Austria, the Great Depression, and ultimately the collapse of the international monetary system. That's obviously an extreme comparison, and we're nowhere near that kind of systemic breakdown. But the point is that monetary systems are fundamentally built on confidence and credibility, and when those foundations crack, the consequences can spiral far beyond what anyone initially anticipated. So where do we go from here, and what are the scenarios that investors and citizens need to be prepared for as this situation continues to unfold? The optimistic scenario is that the DOJ probe concludes relatively quickly, finds either no wrongdoing or minor technical violations that don't fundamentally compromise the Fed's operations. Powell either remains in his position or is replaced in an orderly transition process, and markets gradually stabilize as the uncertainty lifts. In this scenario, we get a volatility spike, some portfolio pain, maybe a mild economic slowdown from tightened financial conditions, but no lasting damage to the monetary system or Fed credibility. The middle scenario, which an increasing number of analysts are viewing as more probable, is that this probe drags on for many months, creates persistent uncertainty that keeps volatility elevated and credit conditions tight, potentially forces Powell to step down or take a leave of absence, leads to a messy leadership transition at the Fed, that introduces even more policy uncertainty and leaves lasting questions about Fed independence and governance that take years to fully resolve. In this scenario, we're looking at sustained market volatility, credit market disruption that meaningfully slows economic growth, possibly a recession if financial conditions tighten enough, and a Fed that emerges structurally weaker and less able to provide clear policy guidance than the institution we've depended on for decades. The worst-case scenario, which hopefully remains a low-probability tail risk but can no longer be dismissed as impossible, is that this probe metastasizes into a full-blown institutional crisis that fundamentally breaks the Fed's operational effectiveness, leads to sustained political interference in monetary policy, triggers a crisis of confidence in dollar-denominated assets that forces international reserve diversification, and potentially unravels aspects of the post-1971 fiat currency system that have underpinned global finance for over 50 years. In this scenario, we're talking about a genuine paradigm shift in how monetary systems function, potentially accelerated adoption of alternative reserve currencies or digital assets, a fundamental repricing of risk across all financial markets, and economic disruption on a scale that most people alive today have never experienced. The truth is that nobody knows which of these scenarios will play out because we're in genuinely unprecedented territory. What we do know is that the market reaction so far suggests that institutional investors are taking the threat seriously, that the smart money is repositioning for elevated uncertainty and potential regime change, and that the cost of being wrong by dismissing this as just another market hiccup could be catastrophic for portfolios and personal wealth. The Federal Reserve under criminal investigation isn't just a headline that will fade away in the next news cycle. It's a potential inflection point that forces every investor, every business leader, every policymaker to confront questions about the stability and sustainability of the financial system that we've all taken for granted for our entire professional lives. The shockwaves we're seeing across Wall Street right now might just be the beginning of a much larger transformation in how global finance functions, who holds power in the monetary system, and whether the institutions we've trusted to maintain stability and prosperity can survive in their current form. This is exactly the kind of moment that separates those who understand what's really happening beneath the surface of markets from those who are just reacting to headlines. And it's the kind of moment that creates both enormous risks and enormous opportunities for those who are prepared. If this analysis has opened your eyes to just how profound this Fed crisis could become, if you're starting to see the connections between central bank credibility and every asset in your portfolio, if you understand that we might be living through a genuine historical turning point in global finance, then you need to stay informed as this situation develops. Smash that like button right now, subscribe to this channel so you don't miss the next deep dive analysis as this story unfolds, and drop a comment below telling me whether you think the Federal Reserve can survive this probe with its credibility intact, or whether we're watching the beginning of a fundamental transformation in how monetary policy and financial markets function in the 21st century, because your perspective matters, and this conversation is just getting started.